welcome to section 4.1, dealing with ledger accounts. In this video, we're going to talk about what is an account, what is a ledger, as well as a brief description of what are T accounts. In regards to what is an account is basically a record that documents each change to items in the accounting equation. So for example, we have a few asset accounts where I'm going to write down here, such as cash is an asset account. Accounts receivable, let's say Mrs. Smith, is an asset account. Equipment is an asset account. As well, we do have liability accounts as well too, which I'll give a few examples, such as bank loan, accounts payable, let's say we're owing Best Buy, as well as we do have mortgage payable as well too. So for example, these are a list of asset and liability accounts. As a result, all these accounts together are called a ledger. So basically what a ledger is, it's just a fancy name for a group or file of accounts. So when we ask what is a ledger, it's pretty much a group of accounts or files that is called ledger accounts. In regards to our T accounts, again, we discussed this briefly in class. So let's take our asset accounts. Let's use cash. We know on the left-hand side we have a debit and we have credits on the right-hand side. Again, asset accounts usually have a debit entry. So for example, in this equation, we have $1,000 that we have in our bank account. Another example of an asset account is from before, account receivable Smith account. We have a debit entry here, we have a credit entry here. And again, an asset account usually has a debit entry. So basically what this is telling us is that account receivable Smith is owing the company $2,000. As she pays off the amount owed, those will be credit entries, but we will discuss that in the next video. Okay, let's take an example. In our last example, let's take a look at liability accounts. So for liability accounts, we have, as I said before, let's say we have a bank loan. Debits and credits. In regards to a bank loan, our liability accounts usually has a credit balance. So for example, we have $5,000 right here. So what this means is that the business took a $5,000 bank loan in which they're going to pay at a later date. Let's say we have accounts payable. I believe we use Best Buy. So again, we have a debit and we have a credit. So just opposite as asset accounts, in regards to our accounts payable Best Buy here, for example, we would have a credit entry. So let's say we have $2,000 here. Basically what this tells us is that the business bought a piece of equipment at Best Buy for $2,000, did not have cash, and as a result, put it on credit. So for example, right now, so we bought a brand new computer, did not pay cash for it, we put on credit, maybe on our Best Buy card, for example, and now we have $2,000 owing to our Best Buy. As we pay off our loan, we will have debit entries, so therefore that will cause our loan to go down. And again, we'll talk more about debit and credit entries in the next video. And our last example is a capital account. So let's say the owner is, let's say, Jackson. The owner is Jackson, we call that Jackson Capital. Again, just like liabilities, in regards to the capital account, it's going to have, let me put the debit and credit in here first. It's usually going to have a credit entry. So let's just say we have $30,000. So we have capital or net worth or equity of $30,000 in the business right now. Anytime we withdraw money or our capital account will go down in value. Anytime we withdraw money, anytime we have an investment in the company, our credit our capital will go up. Anytime we perform a service or we provide a service, our capital count will go up. Anytime we have an expense, it will cause our capital count to go down.